This voice is taken from an article with the title, How Do I Use Economic Cycles to Predict Currency Pair Movements, which has been published on TraderTalks.net. Understanding how to use economic CYC less to predict currency pair movements is an important skill for any forex trader. Economic cycles are the fluctuations in economic activity that occur over time. These cycles are usually measured in terms of economic growth, unemployment, inflation, and interest rates. By being aware of these economic cycles, traders can anticipate how a currency pair will move in the future. When attempting to use economic cycles to predict currency pair movements, there are four main economic indicators that traders should monitor. The first is gross domestic product, GDP. GDP measures the total value of goods and services produced in a country over a certain period of time, usually a quarter or a year. Traders use GDP to measure a country's economic health since it gives them an indication of how the economy is performing. If GDP is increasing, it indicates that the economy is growing, and this can lead to an appreciation of a currency pair. On the other hand, if GDP is decreasing, it indicates that the economy is contracting, and this can lead to a depreciation of a currency pair. The second economic indicator to monitor is unemployment. Unemployment measures the percentage of people in a country who are not employed and are actively looking for work. When unemployment is high, it's an indication that the economy is weak, and this can lead to a depreciation of a currency pair. On the other hand, when unemployment is low, it's an indication that the economy is strong, and this can lead to an appreciation of a currency pair. The third economic indicator to monitor is inflation. Inflation measures the rate at which prices for goods and services are rising. When inflation is high, it's an indication that the economy is growing, and this can lead to an appreciation of a currency pair. On the other hand, when inflation is low, it's an indication that the economy is weak, and this can lead to a depreciation of a currency pair. The fourth economic indicator to monitor is interest rates. Interest rates are important because they affect the demand for a currency. If a country's interest rates are high, it will attract more investors, and this can lead to an appreciation of a currency pair. On the other hand, if a country's interest rates are low, it will discourage investors, and this can lead to a depreciation of a currency pair. By monitoring these four key economic indicators, traders can get a better understanding of a country's economic health and use this information to anticipate how a currency pair will move in the future. Being aware of economy cycles and having a good understanding of the key economic indicators can help traders make more informed decisions when trading forex.